All right. Hello, everyone. Hope you're enjoying your Saturday. So I'm really glad to be here today speaking with you that are in the chat and also in the room in Austin. Um, I I want to thank Car for having me here, for having Timestamp be a sponsor of Top Builder. It's been a pleasure getting to know a lot of you, getting to chat with you, and seeing all the incredible things you're building. So when Car asked about doing a presentation for the builders in PlebLab and Top Builder, I wanted to focus on something that isn't talked about enough in uh, the builder circles, and a lot of it is because you guys are so focused on building great products and working collaboratively to do great things, and uh, it's one of those things that creeps up on you. It's the whole ecosystem of fundraising, particularly around Bitcoin. So I wanted to give you a brief overview of fundraising for your particular company or startup. And I wanted to provide a perspective that I wish I had when I was starting companies, the perspective that I wish I had when I was wondering what to do in terms of fundraising for my company. So I want this to be very introductory and to give you a surface level idea of what to expect. But because I'm a part of Top Builder and I want to continue working with you guys to help you succeed, I want you to know that I have an open door policy. Anytime you guys need anything, need any advice, I'd be happy to meet with you and discuss. So, with that being said, let's start with something that just needs to be said. Is number one thing to note is raising money is hard and it is brutal. It sucks. And I know that what you see from raising money is probably all the great headlines of companies raising 10 million here, 50 million there, or even nowadays billions of dollars when it comes to some of these mega corporations. But the truth of the matter is raising money is hard. So the first question I would ask if I was in your position would be, do I need to raise money? And this is a question that you need to be very serious about because it will define the type of company that you're trying to build. And it will also define the decisions you make as you build that company. So the first thing to realize when you're raising money is that raising money has trade-offs. This isn't a charity, right? Someone is giving you money for your company and they have certain expectations for that money. The biggest thing to realize is their incentives are more than anything to make money. And there are some investors that go above and beyond and they will care about you and they'll mentor you and they'll push you to do great things and they'll connect you. But for the most part, investors want to see results. So the first question you have to ask yourself is whatever it is that I'm building, whether it's at the project stage, the MVP stage, the revenue producing stage, am I willing to give away a piece of this company so that I can grow it? And that leads to the second most important question. Do I need to raise money? So my number one advice throughout this whole talk about fundraising is to really consider whether you need to raise money. And if you have a way to do what you need to do without raising money, that is a best case scenario because you essentially control the company, keep ownership of the company, and it is aligned with your visions and the visions of the people that you're building with. The second you start giving away pieces of your company is the second you start giving away some decision making, some control, some influence. And so you want to be careful as to how you do that. Now, with all that being said, why raise money? I think it's one word, and it's growth. If you're building the type of company that doesn't require growth to get to profitability, then you probably shouldn't be raising money. And that's perfectly reasonable. You could be building a product, you can be building a small business, you could be doing all sorts of things that will make you money without having to raise capital. However, if you're building a startup, like a tech startup, that's going to require growth to get to profitability, that is when you would want to raise money. So you have to also understand the perspective of investors in this scenario. Most investors are not interested in a company that can reduce overhead and generate revenue at a reasonable rate on a monthly basis with low amounts of growth. If they did, they might be more interested in investing in small businesses. What they are really interested in is growth. So, all right, you've decided you want to build a business, you've decided you need to raise money, and you just decided that you're a good fit for raising money because you're creating a growth startup. So when do you actually raise that money? And it may sound silly, but when you can. And this is going to be different for every founder. If you have the type of experience, the type of reputation, the exit experience, as in you've sold a company or you've been acquired before or you've gone public before, if you have that type of experience, generally speaking, you're in a better spot because you can have an idea and you can have people put the pen to paper because they can trust you can execute. But for most people who don't live in that fantasy land, the question of when you can is really dependent on when you can really tell a convincing story to investors, to have them hand over money and expect you to grow it to the point where it's going to outcompete a lot of other things, including potentially Bitcoin, which is one of the challenges of raising in Bitcoin. But that's a topic for a later slide. So my key point when it comes to timing is you want to make sure that you build as long as you can while maintaining control of the early stage of your company. And you want to delay raising money for a couple key reasons. Number one, the first time you raise will be the lowest valuation you get for your company, more than likely. And what that means is that the first time you raise money, you'll give a larger portion of your company away than you would have if you were able to extend out another 6 months, a year, so on and so forth. So you want to be very conscious of the decision you make. There are some general rules of thumb when it comes to fundraising, but I would say if you're raising a full round for growth for the next stage of your startup, you should expect anywhere from 10 to 20% dilution of your company. So the question is, do you want to dilute 20% of your company when you're just starting out and you're offering the company up for pennies on the dollar, or would you rather wait? And so this is a tough decision. So when you raise, it's really dependent on when you can and when you have the ability to tell your story. So that's what I'm going to talk about a little bit today, is what everyone really wants to hear from this talk is, okay, that's great. I heard all that. I heard your warnings. I'm going to ignore them. Now, how do I go raise money? So how do you actually go raise money? Well, it's the way I would describe raising money is it's like a foreign language. You have to learn the language. A lot of founders think they could just put one foot in, one foot out, and do this whole fundraising thing as they're building and not take it seriously. But the unfortunate truth is that if you want to fundraise effectively and you want to be efficient and you want to do the best for your company's future, you need to learn the language of fundraising. There's no way around it. You need to eat the vegetables and just uh, get it over with, learn the language, make sure that you are set up for success. So, how do you do that? Well, first off, you have to understand what your options are when it comes to money. The first two that I have listed on this slide is really dependent on you and your founding team. So, savings and debt. And savings, I highly recommend it if you have enough of a cushion where you can justify using your savings instead of raising money. And it's that equation of whether you want to keep as much equity and control as you can versus giving that away for growth and money. Debt is an interesting one. It's likely my least favorite one of the bunch, unless you have significant cash flow coming in from somewhere else. Then it could be best of both worlds where you're able to service that debt with cash flow and you keep control of the company and you're able to move forward. But for most of you, eventually you'll come to a fork in the road where you are thinking about how can I actually get money that isn't from us or the founding team. We run out. We don't have any more that we can tap into. Well, the first people that you'd likely reach out to are friends and family. But I do want to say something here when it comes to friends and family. Your friends and family love you. They care about you. They want to help you. And a lot of them will likely help you as much as they can. But with that being said, you have the responsibility to let them know exactly what they're getting into. And if you can't explain it to them, then you're probably not ready to raise money anyways. So the first thing you're going to have to explain to them is that investing in startups is risky and most startups fail. And this startup might fail. And you have to be very brutally honest. And sometimes your friends and family are going to say, you know what, I know that might be the case, but I'm willing to support you. What you can't do and what you shouldn't do is, essentially suggest you're the next Apple and Steve Jobs and say, this is guaranteed to be a success. Please invest in us. You won't regret it, Uncle Jim. So just be careful there. And number two, when it comes to friends and family, give them a good deal. So, they're one of your first investors in your company. Don't charge them what you would an angel investor or venture capitalist down the road. They're your first investors. You want to make sure you take care of them. What it means to be a good deal that's a whole other thing. We'll have a discussion about that at some point. Is understanding data and valuations. But when you come to that conclusion of what you're going to raise at for venture capital and outside parties, make sure you take care of the ones that are closest to you. Now, you've tapped out that network of friends and family. Maybe you were able to raise a few, tens of thousands, and then you were able to build to an MVP, or maybe you were able to actually get some traction in your company, and that's all well and good. So now, how do you expand beyond those borders and go out and find these other investors? Well, I'd say there's three general categories, and there are trade-offs between all of them. So angel investors, venture capital, and crowdfunding are your three main options to attract capital in the early stages of fundraising. So angel investors are usually wealthy people that intend to invest in companies as hobby, almost semi-professional, and some are more professional than others. But essentially think of it as people that have been successful in their life, often in startups themselves, who are willing to write checks to early stage startups. Oftentimes, the first checks in your company are going to be from these angel investors. And so the first bit of advice I'd give was once you move beyond friends and family is to mine your network. The people around you, the people in PlebLab, the people in the Bitcoin space, you want to make sure you have some kind of connection to these investors and get introductions so that you can pitch it to them. Now, what's the trade-off with angel investors? Well, the good news is because it's usually one person, if they're an angel investor, they're one solo person. Once they make a decision, they can move. So they agree to invest 25,000 in you. Great, you can send them a document today, and they'll sign it. They'll send over the wire, and you'll be good to go. One of the trade-offs with angel investors is that they tend to be smaller checks because as the solo person, they might be writing, 5, 6, 7 of these checks a year. They might only invest, 5,000, 10,000. So it's going to take a lot of them to actually fill up what you really need. One of the reasons why venture capital exists is because of several of these issues, quite frankly. Number one, their job, what venture capital is, and this is very important to understand, is to allocate capital. What they get paid for is to be able to be selective in what they invest in and make their investors money. They just do it at scale. So a venture capital fund, and we have several in the Bitcoin space, venture capital firms, they raise money from investors. Oftentimes, it's a minimum check size that's fairly large, tens of thousands, if not hundreds of thousands. And these are accredited investors. So these are people that have money, but that don't necessarily want to get involved in investing, or they trust the venture capital firm on their behalf. And so they write a check to these venture capital firms. These venture capital firms take a cut, usually, a 2 and 20, which means they make a percentage on the fee and then a percentage on the profits. And they invest on their behalf. Now, you will, if you get large enough, start raising money from venture capital. The question is, how do you even go about it? Well, first thing with anything is you want to make sure your incentives are aligned. You want to make sure you understand their incentives. Their goal is to make money, but not just make money for themselves, make money for their investors. So here's the trade-off with venture capital. One, and the biggest reason why people keep going to venture capital, and you will too, they write big checks. You can get a check for several $100,000 from venture capital. Two is if they're good venture capital firms, they can connect you to people in their network, whether it's their portfolio companies or other people that might be of use to you. It could be advisors, could be mentors, could be B2B connections. There's a lot of good that they can do. Now, what's the trade-off? Well, because you're accepting that level of capital, one, it's going to take time. You have to remember venture capital is investing on behalf of investors. So they do a lot more due diligence than angel investors. They're going to take their time. They're going to make sure everything's in order. All your documents are in order. All the equity splits are fine. You have a stock option pool. You're doing all the things that you should be doing. Now, once you go beyond due diligence, what are the other trade-offs? Well, I'd say the biggest one is probably leverage. Because you're accepting such a large check, they'll want things in return. So the first most obvious thing is they'll want a better valuation so they can get a larger piece of the company. But I think what a lot of early founders miss out on here is it's not just the percentage that you're being diluted or the percentage that you're giving up of your company, essentially. It is the terms you're giving away with it. So if you don't understand terms like liquidation preference, pro rata rights, these are all terms that you should be aware of before you sign any contract. Unfortunately, there's been a lot of cases of companies who have raised a ton of money and been very successful, and the founders end up with nothing. And it's often not because of ownership, because they might still own a significant percentage of that company. It's often because of the terms that are agreed to. So that's one thing you want to be careful with venture capital. But, they do provide a lot of good services for companies that are growing, and they will always continue to play an important role. Now, one other option you have is crowdfunding. And here's where I'm just going to provide a shameless plug for Timestamp for about 30 seconds or so. So Timestamp, is the company I founded. One of the reasons I founded it is because this process sucks, and I wanted to fix that. So we spent a few years, and what we ended up doing was we created the world's first licensed and regulated investment platform for Bitcoin companies. And that means that if you're a Bitcoin company, you can go on timestamp. You can raise a round on timestamp, whether you want to raise some of it on timestamp or all of it on timestamp. And you can connect to investors, and not just venture capital and angels, but also retail investors. So that would be your community. That means anyone in that room now, anyone that you'd be talking to on the street can invest in your company for as little as $100. So we believe that everyone should have access to these investment opportunities, and not just wealthy and connected people. And also, you should be able to raise from your community. So that's my shameless plug of timestamp. Now back to your regularly scheduled programming here. Let's see. So whether you go through crowdfunding, angel investing, venture capital, some combination of all of them, the first thing you want to do is be prepared. And the first step of being prepared is set your house in order. Now, some of you may not like to hear this, but the first thing you should probably do is talk to a lawyer. It sucks. It might cost you a little bit of money, but you want to make sure that your foundations are set right from the beginning. I always describe it as a cry once now type of feature of building a company. You want to make sure your foundations are set right from a legal perspective, because the decisions you make early on in your company might have outsized effects down the road. So this could be anything from ensuring you've set up your corporation the right way. Is it an LLC? Is it a C Corp? Where is it based out of? Ensuring you do equity the right way. Did you actually create the equity the proper way? Did you distribute it the proper way to your founding team? What is your equity split? What happens if a founder leaves? Did you put in some type of founder vesting? Or if someone leaves, do they just leave with all that equity? These are all questions that you have to be able to answer if someone is willing to invest a ton of money into you. And so my recommendation is, from the very beginning, talk to a lawyer, get things set up right, and so that when you go to investors, you have the confidence that when they go through the due diligence process, that you're set. And if you need lawyers to talk to, PlebLab has references. We have references. So please, we have cost-effective references for early-stage startups like yourself. They'll be glad to help you. I know some people in the chat have used some of our references and PlebLab's references, and they've been happy with them. So please let us know if you need any help on that. But don't ignore it. I know it's one of those things you just don't want to do, is talk to a lawyer and look at documents, but you should do it. So the next step of being prepared is to craft your pitch. So this is I'm going to break it up into two parts, right? So the first part is the 30 seconds or less elevator pitch. If you can't pitch your company in 30 seconds, you don't have a great understanding of what you're building. And if you don't have a great understanding of what you're building, why should an investor invest in you? And these are questions you have to ask yourself. And you might not know the answer now, but you should know it by the time you're fundraising. So my recommendation to you, if you have a whiteboard, great. If you have a notebook, great. Take it out, 2 to 3 sentences, 30 seconds or less. Explain what your company does to a complete stranger. Imagine you're at a conference, or you bump into someone and they say, hey, what do you do? You should be able to say, I'm the founder of Timestamp, and this is what we do. 30 seconds or less. The reason why you want to do it is you want to be succinct, you want to get the message across, and you want people to want to learn more. And so that's where all the fun stuff comes in terms of something like a pitch deck, or essentially a longer pitch that you're telling. I'm not going to go through all these slides one by one, but I do want to highlight a couple things about the pitch deck. Once you get past an intro conversation, someone will want to see your pitch deck. So don't expect to go into a fundraising round without a pitch deck. And don't get too fancy with the pitch deck. Your pitch deck should be relatively standard. The goal is to get people interested, to get people to have a conversation with you if they haven't already. So you want to make sure you get that meeting if you haven't gotten that meeting. And you want to provide them with key information. But there's one thing to remember here. You're dealing with a venture capital firm specifically, or even angel investors. There's a chance that they're looking at hundreds of these a month, especially for the larger firms. So one thing I would recommend is to be able to tell a story that is convincing, that is compelling, but don't stray too far off the path in terms of expectations. So what I've outlined here for you on this pitch deck slide are the things that an investor, particularly a professional investor, like a VC partner or maybe a well-known angel, is expecting to see on your pitch deck. You may stray a little bit in terms of the order. You may stray a little bit in terms of additional stuff or removing things. But generally speaking, this should cover your bases. And if they want any additional stuff, you can always include it in an appendix, or you can pull it up in a conversation. One thing for early stage founders, it's exciting to talk about all the things in great detail, but you don't need to do that, and you probably shouldn't do that because you're giving away too much information. So let's look at some of the things on the pitch deck while we're here. The first two slides are tied together, the first two parts, problem and solution. This, if you don't get this right, then the rest of the pitch doesn't matter. It doesn't matter one bit. So you have to be able to tell your investors what is the problem you're solving, how are you solving it, and what makes you so special. Why are you doing it differently? Why are people going to pay you to do it? And then once you convince them that you're able to solve this pain point, people are willing to pay you for it. The next biggest thing that people want to know is, okay, you solve this problem, but really, how big is the opportunity? If you're an investor, you're more interested in a company that is going into a larger market if the competition and everything else is the same than one that's going into a smaller market. It's just a matter of growth and opportunity. One thing I will say about market size slide, and this probably can be a whole other lecture on its own. A lot of times early founders get market size wrong. And what they do, and it's totally reasonable when you're first starting out, is they say, well, the AI market is, $5 trillion. It's going to grow to $20 trillion by 2028. And so if we just capture 1% of it, our company would be worth this much. So that's what's called a top-down approach. You're essentially saying that this is how big the market is, and we're going to grab a piece of the pie. This really is a very rudimentary way to do modeling. And my recommendation for this market size slide is look up top down versus bottom up. That's all you need to do, and you'll find a ton of resources on it, and you can speak to me about it. You can speak to our CFO, Ryan, about it. He'll be happy to talk to you guys about it. But the goal here is to be able to convey the opportunity with data in a bottom-up approach. And oftentimes that involves more than just the total market. That involves the obtainable market. So that's usually the small circle in the series of concentric circles. In the next circle, the addressable market. So if you have an obtainable market and an addressable market, you have an idea of where you can target right away and where you can grow into. But you want to make sure your assumptions are reasonable when you're creating these projections. And one bit of advice I got, actually from our CFO, who told me about financial projections, market sizing. All models are wrong. Some are useful. But more importantly, when you're raising for a startup, what investors want to see is not necessarily the specific number, although that is important for it to be a certain size for certain investors to be interested. It's really how you got to those answers. What are the assumptions you used? How did you figure out that the market was this? How did you figure out that your obtainable market was that? And if you can reason through your assumptions, then an investor will say, okay, he's done his homework on the market that he's jumping into. He understands his competitors. He understands the opportunity, but he also understands the challenges. So this is why the market size slide and the opportunity slide are so important. And I think this is one of the things that founders miss really early on. It's not something, don't just put the biggest number you can find online in terms of the market on there. Really think about it, really construct it properly, make sure your assumptions are reasonable, and go forward with confidence when investors ask you questions. This is particularly true in the Bitcoin space. I think there's a lot of traps that people can fall into in terms of using Bitcoin as a market size for everything. It could be a reference, but you really want to address the products you're dealing in, the markets you're dealing in, the ecosystems you're dealing in, and not just an asset class. So just be wary of that as you start to build that. Okay, so moving on from market size, the next thing is the benefits. What makes what you build so special? What's so unique about it? What do users like about it? What does it offer that's different from everyone else? And then how it works is really your chance to showcase anything. If you're building a product and you can demo it, even better. If you can if you're super early stage and you can show an MVP of what it would look like, anything is better than nothing. Showing is better than telling. So I highly recommend trying to get something that is a little bit more palatable than just telling them how it works, if you can do it. And if it's simple enough to understand, you might not have to do that. For example, for timestamp, people invest in Bitcoin companies. It's fairly simple. I can show you a video of how people do it, and that might be useful for some people. But ultimately, I think people generally understand how that works. So you have to gauge that depending on what product you're building. Next up is your revenue model. So this is how you're making money, and this is how investors will expect your company to grow in terms of the revenue. Now, you have to understand, because you're raising for a startup, you're likely going to be burning through more money than you're making. And that's actually totally reasonable if you're a growth startup. But even if you're burning money while growing, you want to make sure you have an understanding of your revenue model. And you want to make sure you understand where it's going. Are you going to expand on that one revenue model? Or are you going to add other revenue models? So it could be a fee structure. It could be selling services. It could be all sorts of things. But whatever you're doing, you should understand that revenue model and the business model. So I'll give you a perfect example. When it comes to timestamp is a platform business. It's a two-sided marketplace, right? We have investors on one side, we have companies on the other. So we have to understand both their needs. We have to understand our revenue model in conjunction with them, and we have to align incentives. Now, I know some of you in here might be building businesses that are marketplace businesses. So the first question I would have for you is, have you actually looked into what it's like building a marketplace business? Do you understand how to build a platform? Do you understand how to monetize a platform? And if you're building a SaaS business, have you read anything about building SaaS businesses, how to grow SaaS businesses, how to grow your revenue, your user base? So understand your revenue model, understand its strengths and weaknesses. So there's no one perfect revenue model. Some investors might like some revenue models over the other, but just understand that there are trade-offs. And what are the trade-offs you're making? So, for example, the SaaS model has been very popular over the last decade plus. The reason why the SaaS model is very popular is it provides reasonably predictable revenue on a monthly basis. If you have 100 users that are paying $10 each and the total amount being $1,000 a month, you can reasonably predict what you'll be bringing in next month with some error, which is how many new users we're getting and how many users are we losing. And that gives some investors a lot of confidence in terms of the predictability of the business. Now, there are other revenue models that have potential in the long term based on things like network effects. So, for example, marketplace businesses, but they don't have the same month to month reliability. So, you have to understand that trade off. You have to be able to understand how you're going to be able to deal with those trade offs and how you're going to be able to justify that revenue model. Okay, so now you've done all that. So, that's laying the groundwork for your company. And now you're telling them what you've done. So, what is your traction? Have you formed partnerships? Have you signed clients? How many users have you had? How much money are you generating? What's the growth look like? Is it up and to the right, or is it plateauing, or is it going down? All these things are going to be important to investors. And the more time you have, the more data you have, the more confidence investors will have. So, if you're giving them 1 month of data versus 6 months worth of data, that 6 months of data is way more valuable than any 1 month that you can pull out. So work with what you have. If you're early stage and your metrics are downloads, your metrics are users that are signed up with the platform, that's great. But don't forget to show trends as well. So there's the numbers and then there's the trends. That's what you want to show. Partnerships are always great too, but really ultimately it's going to be up to how many people are using your services, paying for your services, and what's the growth look like. Competitive landscape. You want to be honest with the world that you're getting into. You want to show investors that you understand that there are other competitors out there who might be doing similar things to you. And you want to understand what sets you apart. So if you avoid those conversations with potential competitors, then an investor might think, does he really understand the market he's getting into? Does she understand who the competitors are for her clients? So you need to be able to understand not just the market, but also the competitors in that market so that you know how to address them, you know what differentiates you, and you know how to pitch yourself as something different to investors. Now, your team. Okay, you're doing all this stuff. What does your team look like? So here's what I will say for early stage companies. If you're not Jack Dorsey starting his new company, if you're not Elon Musk starting his new company, you're going to have to build a team that makes sense for what you're building. And you're going to have a team that has skill sets that don't overlap too greatly so that you can allocate your resources properly. That's in an ideal world. Now, you're always going to have some overlap. And I'm going to be quite honest with you. If you're working on a startup with 5 people, 10 people, you're going to wear a lot of hats. You might be a developer, but one day you'll be doing design and another day you might be looking at a financial document. So it's just the reality of the situation. But they want to see that your team has experience is the ideal, skill sets that complement each other is almost a necessity. And then beyond that, it's a matter of proof of work. So even if your team might not be the ideal uh, team on paper, maybe you have developers that are from different backgrounds that wouldn't be expected for what you're building, or you have a first time founder, or you can overcome all of that through execution and proof of work. So this is where I say team matters and will always matter, because that they want to have confidence in the team going forward. But execution and proof of work will help balance some of that out, especially for you early stage founders that don't necessarily have that proof of work in previous companies and exits. And the last few things: what does your roadmap look like? What are you building towards? What are some milestones that are on your roadmap? And what do your financial projections look like? Again, I'm going to say the same thing with financial projections as I said with market size. I think they're related. You're building a model here, so you want to make sure your model has great assumptions and it's something you can back up in conversations with these investors. You don't want to be in a situation where someone asks about your financial projections and you basically say, I have no idea how I got there, in a much longer conversation. I think that's what ends up happening a lot of times, to be quite honest with you. So the last thing, and it's the most important thing really, is to ask, what are you asking for? How much money? What are the terms? What are you looking for? Early stage founders, this deserves a whole other conversation, but there's a 90+% chance that you're raising via something called a SAFE. And a SAFE, if you don't know what that is a simple agreement for future equity. Now, if I say a name, Caroline Levy, none of you would know who this person is. Maybe Teresa might, but she revolutionized early stage fundraising in Silicon Valley because she's the one that created this SAFE document. And what that means is, for early stage startups like yourself, there is a 5-page document called a SAFE, Simple Agreement for Future Equity. You can look it up. You can look up the Y Combinator SAFE. That's the most common one. That allows you to go raise money for your company before you have any idea how to value your company. So essentially, you're able to accept money and push off the valuation until you do a price round where you can have price per share for your equity down the road. That allows you freedom to start raising earlier than ever before. And that allows investors to be able to get a good deal for getting in early on these companies. Now, that being said, you should probably be sure you understand those documents really well before you sign anything. But the SAFE is what you're likely going to use. We can talk about that in another discussion, but it is one of the simplest documents that you will sign. It's 5 pages. There's about 2 or 3 terms that you have to understand. And once you get your head around it, you'll have an idea of what you're getting into if you're raising on SAFEs. All right, next thing on your checklist should be set your timeline. I think this is something that founders get wrong. You're either in fundraising mode or you're not. There's no half measures. If you're going to fundraise, be ready, have your documents ready, have your pitch deck ready, have your list of people ready, and go for it. Don't put one foot in, one foot out, go for it. Fundraising is going to take a lot of your time. And one of the things that is so key is to be able to shorten that time frame, get people interested, close on deals, make sure you keep up momentum the whole time. And the best part about if you handle that properly is that you can close and you can get back to building and you don't have to worry about this. I think what I see a lot of founders doing is saying, I think I want to raise, and then they start like, oh, I think I want to talk to these people and then these people, and then a month goes by and they're like, okay, I'm going to finish up on the next version of this pitch deck, or I'm going to finish up This one, I think one more product release, and then we'll get there. You have to, once you make the decision, you have to jump in with both feet and go for it. No half measures, shorten the timeline, try to get it done. Because one other thing you have to realize is it's going to take time. Very rarely is the first conversation with someone going to be when you close. It might require 2, 3 conversations, if not more, plus due diligence. It's going to take a few weeks, if not months. So be ready for that, and be ready for it to be inconsistent. You'll have weeks where money comes in and then weeks where nothing comes in. But if you're aggressive about it, you're on point, then you can ensure that you can control as much of the territory as possible. Mind your network. This is a big thing. I try to get across to people. Warm intros are way better than cold emails. If you're going to start raising money, you get your documents in order, you get your pitch deck in order before the starting gun goes off. Talk to people. Talk to people in PlebLab. Talk to people in Austin. Talk to people who are building companies that are one step ahead of you. If you're raising a seed round, talk to someone that's raised a Series A. If you're raising your first time, talk to someone that's raised a seed round. See if they know angel investors. See if they know VCs. See if they can give you an intro. Because quite honestly, there's a human element to this, and the human element is it's a lot harder to say no, at least to a meeting, to someone you get introduced to, versus a cold email. Cold email, anyone could ignore it. Anyone could just let it go. The nicest thing some VCs that are not interested in you will do is say, "Thanks, I'll pass," which is always funny because you appreciate them actually responding, but then it's just a cold email back to you. So get warm intros, mind your network, make sure you have the people that you're being introduced to near the top of your list, people you want to talk to early on, because those are your best bets. Your first connections, your second connections, those are your best bets for getting money across the line. Next thing, and I've already touched on this, is once you mine your network, once you're ready to go, you have your list, you have your materials ready to go, attack the race. Don't lollygag around. Don't wait around. Don't take your time in terms of getting out there. If you are going to get your answers, you want to know sooner rather than later. You want to be able to give room for multiple conversations with people, and you want to maintain momentum. If you're raising a larger round, say 1 million, 2 million, 3 million, and that's coming from multiple sources. So once you start getting checks in the door, once you start building momentum, be sure to update some people that are on the fence. Let them know, hey, the first 500K, the first 800K has been filled, and see what the response is like. Oftentimes, some people don't like to be first in investing. They like to wait for the social proof, wait to see that this VC invested or that angel investor invested, and then they might jump in. So if you don't hear a straight no, which you might sometimes, then it's soft no, which is essentially I can be convinced. So make sure you categorize that properly as you're going through your race. Make sure you check in, make sure you provide updates, and make sure you keep the momentum up as you're going through it. And beyond the human element, which there is a human element to this, just realize it is a numbers game. And you're going to get rejections way more than you get acceptances. Be ready for the rejection. Just realize you're probably going to have to talk to dozens, if not hundreds of people if you're going to raise a large enough round. And there are going to be people that you expect to invest that have no interest whatsoever. And there are going to be people where you thought there's no chance in hell they'll be interested, and they'll be diving in headfirst to invest in you. So don't limit yourself. It's a numbers game. Do your networking, reach out. Worst case scenario, even if they say no, even if they don't invest in you, whether it's right away or after a while, they know you're out there. And maybe they might be interested in a future round. Or maybe they might hear of you in the future and say, oh, that guy came to me 6 months ago or a year ago, and he's trying to raise. I'm going to reach back out to him. I'm going to see what he's up to. So worst case scenario, you do some networking. And lastly, you're starting to get offer sheets in, people are willing to invest in you. Make sure you review the terms before you close. I know it gets exciting, so I'm going to say it again, talk to a lawyer. Just do it. Just do it. You're accepting all that money, you might as well pay a little bit to a lawyer to make sure that it's coming in with the right strings attached and not all the sorts of bells and whistles that might destroy your company and your ownership stake in that company in particular. And one last thing before I end this off, and I want to say, I really admire a lot of you. I know what you're going through. Building a company is very, very difficult. It can feel lonely at times, especially if you're going through a fundraising process or you're gearing up for a fundraising process. A lot of times it feels like you're really putting yourself out there and you're vulnerable. And you're going to get rejected and it's going to suck. But eventually, if you're building something that people believe in and you can make them believe in it, then you have a chance to succeed. And so the biggest thing that I try to remind you that's going to help you with your fundraising is remember your why. Remember why you started this in the first place. Remember what your mission was. Why did you start the company? What compelled you to spend your valuable time, the most valuable asset you have outside of Bitcoin itself? What compelled you to spend your time building this company? If it's money, that's fine. You can make money. But really, what is that underlying foundation for why you built that company? And that why will push you when things are tough, but it will also help with your fundraising. Your mission, your vision, why you built your company is ultimately why investors are going to believe in you. On paper, if there are two companies, two founders with the same mission, same product, same goal, same type of team makeup, everything else is the same across the board. The one thing they're going to look at is the founder or the founders, and they're going to say, does that person have it? Do they really care? Will they really care when it's 2 o'clock in the morning on a holiday and the site crashes and they got to go put in the work and make sure it's back up, or when a customer complains and they got to fix the issue, or there's a lot of reasons to quit, a lot, and you'll find more of them the longer you go. So they need to know, and you need to know, why you built this in the first place, why you continue to build it, why you believe in it. And if you can do that successfully, if you can tell that story, then that is a great starting point to start fundraising for your company. So I'm going to pause there. Hopefully this was a good intro lesson for you guys. And one other thing I want to say here at the very end is you're not alone in this. I think if you're an early stage founder, I want you to know that my door is open to you. PlebLab's door is open to you. There are so many people in this community that are willing to help you. So please don't feel like you don't have the resources you need. Just reach out. I have an open door policy. I won't charge you anything. I want you to succeed. I want more great Bitcoin companies to be built. So with that being said, thank you all so much for your time. And I'm going to open up the conversation. So if anyone has any questions, please let me know either in the chat or there in Austin. Let me know and I'll be happy to answer them.